You're about to join into the world of systematic market cycles. Learn the most dependable and consistent, yet often overlooked investment strategy. Welcome to the Technical Intrinsic Value Podcast.
The mathematical formulas you are currently using to protect your entire net worth, well, they were mathematically proven to be catastrophically broken over 2 decades ago.
Right.
I mean, the models telling you your portfolio is perfectly diversified, the risk metrics your broker just hands you on your dashboard, the calculations determining your stop losses, they are all basically built on a statistical lie.
Yeah, it really is the great open secret of quantitative finance. We have this entire global infrastructure running on risk models that empirically fail the very moment the market experiences real stress.
Exactly.
It is essentially the equivalent of designing a commercial airliner with an autopilot that works perfectly in clear skies, right?
Yeah.
But then it aggressively pitches the nose down the second it hits turbulence.
Which is terrifying. And with that, welcome to the deep dive. And if you are listening to this right now, I'm speaking directly to you, the frustrated intermediate retail investor.
The ones who already know the basics.
Right. You aren't a beginner. You know what an options chain looks like. You understand beta. But I know exactly where you are right now. You are checking your phone under the table during a meeting.
Oh, absolutely.
You are waking up at 3 a.m. to see what the overseas futures markets are doing, trying to gauge the European Open. You are completely trapped in this exhausting cycle of short-term headlines, trying to outtrade the noise.
And feeling that absolute emotional whiplash of a market that seems to just constantly defy the very logic you have been taught to rely on.
Exactly. And that anxiety you're feeling, it isn't a psychological weakness on your part.
No, not at all. It is a structural failure of the tools you have been given. I mean, you have essentially been handed a broken compass and told to navigate a Category 5 hurricane.
Which is exactly why we are dedicating this entire deep dive to a complete teardown of those broken tools. Today's mission is, well, it's transformational. We are dissecting a really definitive, paradigm-shifting research piece.
Right, the work by Niccolò Primavera Carvalho.
Yes, titled Beyond Volatility, a quantitative analysis of portfolio variance, statistical probabilities, and advanced risk modeling. Our goal today is to transition you out of that anxious, guessing gambler mindset.
And pull you right into the patient, strictly data-driven reality of a professional.
That's the mission. But before we tear into the mathematics, we need to set the baseline for you, the listener.
Right. It is crucial to state that all of the analysis, the quantitative critiques, and the theoretical frameworks we are discussing today, they reflect the direct views and research of Niccolò Primavera Carvalho, the creator of the Technical Intrinsic Value model.
Or the TIV model, as we'll call it. And a quick friendly reminder, if you want the ultimate physical guide to everything we're about to unpack, do not forget to pick up Niccolò's book.
Yes, Technical Intrinsic Value.
Exactly, which is currently available on Amazon. Consider it the definitive textbook for escaping that emotional trap of retail investing we were just talking about.
And that emotional trap is really where we need to start, because it's the symptom of the bad math.
Oh, for sure.
Retail investors, even the intermediate ones with years of screen time, they operate in this perpetual state of cognitive dissonance. You watch your portfolio swing. You read a macroeconomic report suggesting tech is overvalued.
Right, so you panic a little.
Exactly, so you liquidate your positions to protect your capital. But then the next day, the NASDAQ rallies 2%. And the subjective bias instantly kicks in.
The fear of missing out.
Right. FOMO overrides your previous thesis, and you buy back in at a higher cost basis. You are perpetually buying on hype and selling on fear, entirely because you are reacting to the splashing waves instead of the underlying current.
I love that analogy. You're reacting to the waves, and that friction between qualitative narratives and quantitative reality is what absolutely kills your returns.
It destroys alpha.
It does. And the traditional advice from legacy financial media, it really doesn't help either. They just tell you, buy and hold, write it out, time in the market beats timing the market.
Which is fine if you're a passive indexer not looking at your account for 30 years.
Right. But for an active intermediate investor managing their own capital, buy and hold often just devolves into qualitative guessing masquerading as wisdom.
Oh, absolutely.
You end up holding a bleeding asset because you like believe in the CEO's vision, or because you read some compelling narrative on a financial blog and you completely ignore the mathematical degradation of your equity curve.
And subjective bias is the absolute enemy of compound returns. I mean, the market does not care about a CEO's charisma or a media narrative.
It really doesn't.
The market is a complex, adaptive system driven by capital flows and statistical probabilities. And this is exactly where the TIV approach violently shifts the paradigm.
Okay, let's unpack this. Because the technical intrinsic value model, it completely strips away that narrative, right?
Completely. It looks exclusively at the empirical statistical realities of how an asset behaves mathematically over time. By replacing qualitative hope with quantitative data, you introduce structural discipline.
I want to push back on that slightly because the frustrated investor we are talking to, they are looking at data.
Are they, though?
Well, they think they are. They are staring at moving averages, RSI indicators, implied volatility ranks all day long. They have 4 monitors full of data, but it's just noise to them. So how does the TIV framework actually differentiate between the noise that causes anxiety and the data that provides discipline?
That is the critical distinction. Staring at a lagging indicator, like a 50-day moving average, is not statistical data discipline. It is just technical noise chasing.
Okay, that makes sense.
True data discipline requires understanding the underlying structural risk of the asset. It requires knowing the mathematical boundaries of its behavior.
Meaning you actually know what's normal for that stock and what isn't.
Exactly. When you understand the actual probability of a specific downside deviation, a market drop stops being a terrifying surprise. It becomes a quantified, expected event.
You don't panic because you already modeled the event into your position sizing.
Precisely. But to model it correctly, you have to understand where the standard risk metrics go completely off the rails.
Well, let's get into those rails then. Let's talk about the genesis of modern portfolio theory. Because to understand why the models are broken, we really have to look at the bedrock they were built on.
Variance and volatility.
Right. And I always find it fascinating that before Harry Markowitz published his paper, Portfolio Selection, back in 1952, finance didn't really have a mathematical definition for risk.
It was entirely subjective.
Exactly. You just looked at a railroad company's balance sheet and made a qualitative judgment. But Markowitz comes along and says, no, risk is dispersion. It is the second moment of the statistical distribution.
And that was a brilliant leap, defining risk as the variance of returns around their expected mean.
So if an asset averages a 10% return, but historically swings wildly between, say, up 40% and down 20%, it has high dispersion.
Right, high variance.
Yeah.
And if another asset averages 10% but tightly clusters between 8 and 12%, it has low variance.
The math for variance, which is denoted as sigma squared, is pretty straightforward, but it's highly problematic. You take the daily returns, subtract the average return, and square the difference.
And then you average all those squared numbers together.
But here is the massive practical issue with variance that Carvalho highlights in the text. And it's something anyone building a model runs into immediately. The output is basically uninterpretable.
Right, because of the units.
Exactly. If my returns are in percentages and I square them, my variance is expressed in percent squared.
Which means nothing.
Right. There is no real-world application for percent squared. You can't visualize what a percent squared loss looks like in your brokerage account.
Which is why the industry relies on standard deviation. You
Yeah.
just take the square root of the variance to return the metric back to its original interpretable units.
So volatility, as it's commonly discussed on financial TV, is simply this standard deviation.
Yes. But the mathematical act of squaring those deviations in the first place to get the variance is a structural double-edged sword. And it sets the stage for massive model failure.
Because of how squaring heavily weights the outliers.
Exactly. Think about the math. If a daily return is 1% away from the mean, 1 squared is 1. It adds a weight of 1 to the variance.
But if a sudden market shock pushes a return 5% away from the mean,
5 squared is 25. That single day exerts 25 times the gravitational pull on your risk metric compared to a normal day.
wow. So the mathematical intention behind this is sound, right? A model should heavily penalize wild swings because they represent instability.
In theory, yes. However, when you apply this to a historical time series to predict future risk, a single massive anomalous black swan event completely breaks the model.
Like the flash crash of 2010 or the initial COVID shock in March 2020.
Right. Those events artificially inflate the forward-looking risk profile for months or even years. The model basically looks in the rearview mirror, sees that massive squared outlier and projects terrifying instability into the future, even if the systemic shock has completely resolved.
It creates a ghost in the machine. You are pricing in a crisis that has already passed, which keeps you out of perfectly good trades.
Exactly. You're sidelined by phantom risk.
Okay, let's walk through the actual step-by-step mechanics of how an institution or a quantitative model calculates the volatility of a single asset. Because the retail investor relying on, Yahoo Finance metrics, they rarely understand what's happening under the hood.
It's important to pull back the curtain on this.
Step 1 is data acquisition. Getting a clean, statistically significant time series of daily closing prices, usually 1 to 3 years of data. But step 2 is where the first major academic line in the sand is drawn.
Yes, the debate between simple returns versus logarithmic returns.
Right, and Carvalho is very clear on this.
Oh, absolutely. If you are building a time series model and you use simple returns, your model is immediately compromised.
Why is that? I mean, simple returns seem intuitive. Today's price divided by yesterday's price -1.
They are intuitive, but simple returns compound. They are multiplicative. Think about it. If you lose 50% on day one, a $100 asset drops to $50.
Right.
To get back to $100 on day two, you don't need a 50% return. You need a 100% simple return.
Oh, right, because 50 times 2 is 100.
Exactly. The math is asymmetrical, and this compounding violates the foundational assumptions of ergodicity that are required for time series modeling.
And that's exactly why quants use log returns instead.
Precisely. Logarithmic returns are continuously compounded, and crucially, they are time additive.
Meaning you can just add them up.
Right. If I take the log return of 5 consecutive trading days, I can simply sum those 5 numbers together to get the exact aggregate return for the week.
Which eliminates that compounding drift that totally distorts simple return series.
Yes. So you calculate your daily log returns, find the variance by squaring the deviations from the mean, take the square root to get your daily standard deviation, and then
we have to annualize it because nobody really thinks in terms of daily volatility.
And annualizing is where another piece of standard industry convention comes in.
You don't multiply daily volatility by 365, right? Because markets aren't open on weekends or holidays.
Exactly. You multiply the daily standard deviation by the square root of 252, because 252 represents the average number of trading days in a calendar year.
Okay, so that gives us our baseline. But let's scale this up. Measuring the standalone volatility of a single stock is great, but nobody listening to this holds a one-asset portfolio.
No serious investor does.
Right, and this is where modern portfolio theory introduces its most profound and honestly most complex concept, the mechanics of diversification.
The foundational rule here is that portfolio risk is not a simple weighted average of its underlying assets.
The whole is literally less than the sum of its parts.
If built correctly, yes. It is the interaction between the assets that dictates the structural integrity of the portfolio.
Give me an example of doing it wrong, then.
Well, if you hold 50 different tech stocks that all move in the exact same direction during, say, a semiconductor shortage, you haven't diversified your risk at all.
You've just fragmented it.
Exactly. You have fragmented your capital across highly correlated expressions of the exact same underlying risk.
So the engine that measures this interaction that tells you if you are actually diversified is covariance, and its standardized derivative, correlation.
Right. Covariance measures the joint variability between two assets. It tells you whether they move together or inversely.
But raw covariance has a problem, right? It lacks magnitude clarity.
It does. A covariance of 0.04 doesn't inherently tell you if the relationship is strong or weak unless you also know the standard deviations of both assets.
Which is confusing, and that's exactly why we use correlation, denoted by the Greek letter rho. Correlation strips out the noise and gives us a perfectly bounded scale between -1.0 and +1.0.
And understanding that scale is the absolute prerequisite for professional portfolio construction.
Here is where it gets really interesting for the listener. Let's break down the scale. A correlation of +1.0 means perfect positive linear relationship.
They are identical twins. Where one goes, the other goes. Zero diversification benefit.
Right. A correlation of 0 means the assets are entirely uncorrelated. The movement of one gives you absolutely 0 predictive power over the movement of the other.
Which is a highly realistic goal for reducing risk.
But a negative 1.0 correlation, that is the theoretical holy grail, isn't it?
It is perfect inverse movement. If asset A drops 10%, asset B rises exactly 10%.
So if you perfectly balance a portfolio with a negative 1.0 correlation, you mathematically eliminate all variance. You literally create a risk-free asset out of risky components.
Obviously, perfect negative 1.0 correlations don't exist in the real world of equities. But finding assets with a correlation hovering near zero or slightly negative is the goal. It is literally the only free lunch in finance.
But executing this mathematically across a massive portfolio, it requires us to move away from simple algebra and into matrix algebra, which sounds intimidating.
It is dense math, but it's crucial. I like to think of a portfolio's risk structure as a massive spider web.
The spiderweb analogy is perfect for this. Let's unpack that.
If you have a two-asset portfolio, the web is very simple. You have the variance of asset A, the variance of asset B, and a single thread connecting them.
The covariance.
Right. That's three components determining your total risk. But the moment you expand to a standard institutional portfolio of, say, 100 assets, the math explodes geometrically.
Because to find the true risk of the portfolio, you don't just calculate 100 individual variances.
No, you have to calculate how every single asset interacts with every other asset simultaneously. You have to measure the tension on every single thread in that web.
So for a 100-asset portfolio, using the formula n times n minus 1 divided by 2, you have 4,950 distinct covariance relationships to calculate.
Exactly. That matrix of 4,950 interactions is your covariance matrix.
That is just massive. And the profound mathematical reality that retail investors often miss here is that as a portfolio grows, the individual standalone risk of any single stock basically approaches zero in its impact on the total portfolio.
Because the idiosyncratic risk is diversified away. What remains, and what utterly dominates the portfolio's total risk profile, is that covariance matrix. The interactions are the only thing that matters.
Okay, I'm going to play devil's advocate for the frustrated retail listener right now. Matrix algebra is heavy. Let's ground this massive matrix concept into a very tangible example from Carvalho's text so we can actually see this mathematical free lunch in action.
Okay, let's assume a highly simplified two-asset portfolio. You allocate 60% of your capital to a volatile tech stock, which has a daily standard deviation of 2.0%.
Okay, 60% in tech at 2.0% volatility.
Got it. And you allocate the remaining 40% to a stable utility stock with a daily standard deviation of 1.0%.
Now, if I just took a weighted average of those two, my portfolio volatility would be 1.6%.
Right. But let's assume the correlation between the tech stock and the utility stock is a low positive 0.2. When you run those weights, those individual volatilities and that 0.2 correlation coefficient through the portfolio variance formula, the overall daily standard deviation of the portfolio drops to 1.34%.
Wait, really? It drops all the way down to 1.34%. That is below the weighted average.
Yes. The mathematical interaction of holding uncorrelated assets literally destroys a portion of the total risk. It suppresses the total variance.
So that 1.34% sounds great. It sounds comforting. But here is the major pivot of this deep dive. How does that percentage actually translate to real dollars won or lost in a market crash?
And that right there is the trap. That 1.34% standard deviation figure is only useful if it accurately translates into a reliable probability of loss.
Right.
It only matters if that metric truly maps to the reality of how financial markets behave. And, spoiler alert, it doesn't.
It really doesn't. And this is the turning point, folks. The pivot from theory to the harsh empirical reality of the market. Because all of these models, modern portfolio theory, the Black-Scholes options pricing model, the standard deviation metrics printed on every mutual fund fact sheet,
they all fundamentally rely on one dangerous statistical promise, the Gaussian assumption.
They assume that market returns are normally distributed. They assume the market is a bell curve.
Right. And the normal distribution is a beautiful, elegant mathematical construct. It is perfectly symmetrical around the mean.
Which implies that extreme events are exceptionally rare.
Exactly. It assumes that the vast majority of trading days will cluster closely around the average return. And as you move further away into the extremes, into the tails of the curve, the probability of those extreme events occurring drops off exponentially.
It gives birth to the empirical rule, the 68, 95, 99.7 framework. Let's break that down.
Sure. If the market is a perfect bell curve, 68% of all trading days will result in a return that falls within one standard deviation of the mean.
Meaning a loss greater than one standard deviation should only happen roughly 1 in every 6 trading days.
Right. And as you push out to the boundaries, the promises become even more extreme. The model dictates that 95% of all data points fall within 2 standard deviations.
Therefore, a 2 sigma loss should only occur once every 44 trading days.
And a 3 sigma loss covers 99.7% of the curve, meaning an event that volatile should only happen about once every 3 years.
But the real danger lies in the details. According to the normal distribution, a 5 sigma event, a catastrophic portfolio-wiping market crash, is so statistically improbable that it should theoretically only happen once in 3.5 million trading days.
That's roughly 13,800 years.
Wow. So the bell curve promises you that catastrophic ruin is virtually impossible within your lifetime.
It lulls institutions and retail investors alike into this profound sense of false security. But empirical market data, the actual observable history of global equities, screams the exact opposite.
The market does not look like a bell curve.
No, it exhibits a statistical property known as leptokurtosis.
Let's unpack leptokurtosis, because this is where the intermediate investor really needs to level up their understanding of statistics. We talked about variance being the second moment of a distribution. Kurtosis is the fourth statistical moment.
Right. Kurtosis measures the extreme values in either tail.
So when Carvalho says a distribution is leptokurtic, we are saying 2 things happen simultaneously that break the normal model. First, there is a higher, sharper peak in the center.
Meaning there are far more incredibly boring, zero-movement, flat trading days than the bell curve predicts.
It's just sideways chop.
Exactly. But the real devastation lies in the second property.
Fat tails.
Fat tails. In a normal distribution, the probability in the tails tapers off to basically 0 extremely fast. The line just hugs the floor. But in a leptokurtic fat-tailed distribution, those extreme edges are lifted. They are thicker.
There is far more area under the curve at the extremes, which translates to this brutal reality. Massive violent market deviations, 3 sigma, 4 sigma, 5 sigma events, they happen exponentially more often than the standard deviation model allows. Think about the 1987 Black Monday crash, the 1998 Russian debt default, the 2000 dot-com implosion, the 2008 systemic banking collapse, the 2020 COVID flash crash.
According to the normal distribution, we shouldn't have seen a single one of these in 10 millennia.
And yet we saw all of them in 35 years. It's like building a house on the coast. Relying on standard deviation is like building your house to withstand a Category 2 hurricane because the math says Category 5s only happen every million years.
Right. Only they get hit by a Category 5 4 times in a single decade.
Exactly. Standard deviation is fundamentally flawed as a predictive risk metric because it is willfully blind to the fat tail. And beyond the fat tail problem, standard deviation has another crippling flaw for the retail investor. It is perfectly symmetrical.
Right. The math squares the deviation regardless of whether it's positive or negative. It treats a sudden 20% portfolio gain as equally risky as a 20% portfolio crash.
Which defies the entire psychological reality of investing. Risk to a human being is not upside volatility. Risk is the permanent impairment of capital.
Absolutely. No retail investor loses sleep because their tech stock gapped up 15% on an earnings beat. They don't view that upside volatility as a threat.
They view downside crashes as the threat. But standard deviation makes absolutely no distinction between the two. Also, standard deviation is purely historical. 2007 volatility was absolutely no predictor for the 2008 crash.
Exactly, and the financial industry actually recognized this flaw. They knew standard deviation was symmetrical, backward-looking, and completely vulnerable to fat tails.
So what does this all mean for you, the listener? If standard deviation is fundamentally broken and dangerously misleading, how do the actual professionals measure risk?
Well, in the 1990s, the brightest quantitative minds at firms like J.P. Morgan developed a new metric designed specifically to focus only on downside risk. They created the industry standard, value at risk, or VAR. Yes, VAR was a revolution in risk management because it asked a very specific one-sided question. What is the maximum amount of money we can expect to lose over a given time horizon at a specific confidence level?
It strips away the upside entirely and attempts to quantify the threshold of pain. Let's walk through the mechanics of a VAR calculation to show exactly how it works before we expose its fatal flaw.
Okay. Let's return to our 60/40 tech and utility portfolio with a daily standard deviation of 1.34%.
To calculate the 95% confidence VAR, we use a z-score. For one-tailed 95% confidence interval, the z-score is 1.645.
You multiply your 1.34% standard deviation by that 1.645 z-score, and you get a 95% VIR of roughly 2.20%.
So as an investor, if I see a 95% VIR of negative 2.20% on my dashboard, the interpretation is highly specific. It means I am 95% confident that my portfolio will not lose more than 2.20% in a single trading day.
Or, flipped around, you expect your daily losses to exceed 2.20% on exactly 5 out of every 100 trading days.
It provides a very clean, understandable boundary.
It does. It tells an institution exactly how much capital they need to hold in reserve to survive a normal bad day. VAR became the absolute backbone of global finance. Regulators adopted it, hedge funds optimized for it, and trading desks were assigned strict daily VAR limits.
But VAR contains a devastating mathematical blind spot. And this blind spot is honestly my favorite part of Carvalho's research because it perfectly illustrates the danger of taking an incomplete metric to its logical extreme.
Right. VAR tells you exactly where the tail begins. It tells you the location of the gate to the tail. But it tells you absolutely nothing about the magnitude of the monster waiting inside the tail.
It's a quantile metric. It is literally just a line in the sand. If your 99% VAR is $10 million, it means there is a 1% chance you will lose more than $10 million.
But the mathematics of VAR are completely silent on whether that 1% event will result in a loss of $10,001,001 or a complete unrecoverable wipeout of $1 billion.
It does not measure the severity of the tail risk at all. It only measures the frequency of crossing the threshold.
Which brings us to the most infamous case study in modern financial history, a perfect real-world example of the VAR catastrophe. Long-term capital management in 1998.
LTCM. And they weren't run by retail investors checking their phones. LTCM was run by John Merriweather from Salomon Brothers, alongside Myron Scholes and Robert Merton, guys who literally won the Nobel Prize in economics for their options pricing models.
They had the smartest quants and the absolute most advanced VAR models on Earth.
And they used those highly advanced VAR models to engineer their own complete destruction.
Because LTCM was highly confident in their VAR limits, they believed they precisely understood their downside boundary. They saw that the historical variance in their bond arbitrage pairs was incredibly low.
So to generate massive returns on tiny price discrepancies, they applied catastrophic levels of leverage. They optimized their entire portfolio to sit right on the absolute edge of their VAR limit. They were basically picking up nickels in front of a steamroller. And the VAR model was telling them the steamroller was moving at exactly 2 miles per hour.
But the market is leptokurtic. The 1998 Russian financial crisis triggered a massive sovereign debt default, causing global correlations to instantly snap to 1.0.
Flight to liquidity meant everything sold off together. The spider web of the covariance matrix we talked about completely collapsed.
They crossed their VAR threshold. And because VAR had told them nothing about the depth of the fat tail, the leverage they had applied based on that false confidence completely vaporized their equity.
A fund managed by Nobel laureates, utilizing the pinnacle of standard risk metrics, lost $4.6 billion and nearly took down the global banking system.
And this exact dynamic repeated itself a decade later during the 2008 subprime mortgage crisis. Institutions optimized to their VAR limits, ignoring the severity of the tail.
So if standard deviation is fundamentally flawed by symmetry and the Gaussian assumption, and if VAR is a dangerous trapdoor that ignores the severity of the fat tail, what is the actual professional-grade solution? What metric do advanced quantitative frameworks like the TIV model actually use to map risk?
The evolution of risk management led to conditional value at risk, or CVR. It is also referred to academically as expected shortfall. CVR was designed mathematically to fix the exact blind spot that destroyed LTCM.
Let's explain the mechanics of expected shortfall. If VAR asks, what is the minimum amount I will lose in the worst 5% of cases, CVR asks the much more terrifying but vitally necessary question. In those worst 5% of cases, what is my average expected loss?
Right. It is literally taking the mathematical integral of the tail. CVR calculates the expected value of the losses strictly conditional on the VAR threshold being breached.
So it dives into the fat tail, looks at all the potential catastrophic outcomes, the 3% drops, the 10% drops, the 50% wipeouts.
Weights them by their probability and gives you the true expected severity of the tail event.
Yeah.
By definition, your CVR will always be a larger, more conservative number than your VAR.
And beyond just quantifying the tail, CVR solves a massive structural problem that VAR has regarding diversification. The text mentions that CVR possesses a mathematical property called subadditivity.
Right, which means it is a coherent risk measure. I want to spend a moment here because this exposes just how broken VAR really is.
Yes, please, explain subadditivity.
Subadditivity is a required property for any logical risk metric. It mathematically dictates that the combined risk of two portfolios must be less than or equal to the sum of their individual risks. It is the mathematical proof of diversification.
Risk A plus risk B must be greater than or equal to the risk of A and B combined.
Exactly. Because if you combine two portfolios and the risk magically increases, the entire concept of diversification is a lie.
Right.
CVR is strictly subadditive. It always respects diversification. But incredibly, VAR is not.
Wait, really? VAR can show an increase in risk when you combine portfolios?
Yes, in complex, nonlinear portfolios, specifically those with heavy derivatives exposure or highly skewed distributions, VAR can mathematically break. The VAR of a combined portfolio can actually show up as higher than the sum of its parts.
Which is an absurd illogical output that can lead a risk manager to make catastrophic allocation errors.
Because CVR is mathematically coherent, and because it explicitly quantifies the severity of the fat tail, the global regulatory framework has finally shifted. The Basel Committee, which governs global banking regulations, they formally transitioned the banking sector from VAR to expected shortfall, CVR, for market risk frameworks.
It is the undisputed gold standard for institutional risk mapping. Okay, let's bring this back to you, the intermediate retail investor sitting at home looking at your screens. How do you implement this? You aren't a global bank. You are managing your own capital.
The transition from relying on standard deviation to adopting a CVR mindset is ultimately a psychological shift. It completely changes how you interact with the market on a daily basis.
Right. When your worldview is anchored in standard deviation, you are constantly surprised by the market. Every 3 sigma move feels like an unprecedented crisis, which induces panic selling.
But when your mental framework shifts to CVR, you have already acknowledged, quantified, and sized your portfolio for the fat tail. You stop pretending that a worst-case scenario is just a minor dip.
You force yourself to quantify actual downside losses. You've already measured the monster in the dark, and when you know exactly how big the monster is, it loses its ability to terrify you.
That data discipline is the ultimate antidote to the emotional whiplash of retail trading. You stop checking the European futures at 3 a.m. because tomorrow's daily variance is completely irrelevant to a portfolio built to withstand the calculated expected shortfall.
And this is exactly where the TIV cycle analysis becomes the operational framework for the retail investor. It is one thing to theoretically understand CVR, but it is another entirely to apply it dynamically.
Right. TIV cycle analysis doesn't rely on static historical lookbacks. It utilizes advanced quantitative structures to continuously reevaluate the covariance matrix and tail risk probabilities across different time horizons.
Wait, let's dig into the mechanism of that. Because traditional models just look at a rolling window of past data, say 252 days, and assume the future will look exactly like that window. How does TIV cycle analysis differentiate itself from just being a rolling historical regression?
TIV cycle analysis operates on the understanding that markets undergo structural phase shifts. During a prolonged bull market, correlations between asset classes might be low, and the tails might thin out.
Everyone feels safe.
Right. But when systemic stress enters the system, liquidity evaporates, and the covariance matrix undergoes a phase transition. Correlations rapidly approach 1.0.
Everything moves together.
Exactly. TIV cycle analysis algorithms map these phase-shifting correlations and adjust the expected shortfall models dynamically, identifying exactly when the probability of entering a fat tail environment is mathematically increasing.
So it's actively measuring the changing shape of the distribution rather than assuming the distribution is static. That is how you stay disciplined during massive market swings.
You aren't guessing if the trend is breaking. You have a mathematical framework that is actively quantifying the structural risk of the current cycle.
It allows you to maintain absolute emotional discipline. Patience in the market isn't about ignoring reality. It is the natural byproduct of having superior data. But bridging the gap from a retail trader guessing on price action to an investor deploying dynamic CVRR and phase-shifting covariance matrices, that is a massive leap.
It's not something you just pick up over a weekend.
No. You don't learn how to integrate expected shortfall into dynamic timeframes by watching a 5-minute video online. It requires rigorous, high-level instruction. It requires a mentor.
It requires extreme focused dedication to master the quantitative logic. And that is exactly why the Technical Intrinsic Value program was created. It is not a mass market automated trading course.
Far from it.
It is a highly exclusive, high-integrity mentorship designed to transition you fully into this professional, data-driven reality.
And we need to emphasize the exclusivity of this because it speaks to the depth of the material. The TIV program is strictly limited to a maximum of 5 students at any given time. Maximum 5 students.
This ensures that every single individual receives the absolute top-to-bottom mastery required to implement the TIV model correctly.
It is intimate, intense, and transformational. If you are exhausted by the anxiety, if you are ready to replace qualitative guessing with professional-grade data analysis, you need to secure your place. You can join the waiting list right now at www.technicalintrinsicvalue.com.
Do not delay, because with a hard cap of 5 students, those spots represent a rare opportunity to fundamentally change your financial trajectory.
Again, that is www.technicalintrinsicvalue.com. It is the definitive path out of the emotional trap. It is how you learn to stop trading the noise and start trading the mathematics of risk.
Moving from a gambler to a professional.
All right, as we move into our final synthesis, let's map the ground we've covered in this deep dive. We started with the very real psychological toll of the intermediate retail investor, the anxiety born from relying on qualitative narratives in a quantitative system.
Then we moved into the foundational building blocks of risk, exposing how standard deviation and variance technically function, but critically, how they artificially inflate past anomalies through squaring and fail entirely to distinguish between upside gains and downside ruin.
We scaled up to the covariance matrix, proving mathematically that the interaction between assets is the only true driver of portfolio risk, and that correlation provides the only mathematical free lunch via diversification.
But we also shattered the illusion that those metrics can be trusted because they rely on the Gaussian assumption, the absolute lie of the perfectly symmetrical bell curve.
We introduced the empirical reality of leptokurtosis, proving that the market generates extreme, catastrophic fat tail events at rates that render standard normal distributions useless. We explored the financial industry's flawed patch for this, value at risk, and demonstrated through the collapse of long-term capital management how optimizing for the boundary of a tail without measuring its depth leads to systemic ruin.
And finally, we arrived at the professional standard, conditional value at risk or expected shortfall. The coherent, subadditive mathematical reality that forces you to quantify the absolute worst-case scenario.
We established that by integrating CVR into dynamic TIV cycle analysis, you strip away the subjective bias, you eliminate the daily anxiety of market noise, and replace fear with data-driven conviction.
It is a complete tearing down of legacy assumptions, replacing them with a framework built for the market as it actually exists, not as an academic model wishes it to be.
But before we sign off, we want to leave you with one final provocative thought. We have spent this entire deep dive meticulously breaking down statistical probabilities, linear correlations, and the depths of fat tails. But there is a frontier of quantitative analysis that pushes beyond even this.
Indeed there is. What if the market isn't merely a series of randomized statistical probabilities and stochastic processes?
What if, beyond the linear math of expected shortfall and covariance matrices, the market actually moves in predictable geometric structures?
What if there are cyclical fractals, repeating patterns of nonlinear market geometry that standard risk models, no matter how advanced, completely fail to visualize because they are only looking at the math and not the shape?
It's a chilling, fascinating concept. So I leave you, the frustrated intermediate investor, with this question to mull over the next time you check your screens. If your advanced risk model only measures the frequency and severity of the waves, who is measuring the underlying shape of the ocean floor?
A profound question, and one that redefines everything we think we know about price action.
Thank you for joining us on this incredibly dense, rewarding journey into the mechanics of risk on the deep dive. Trust the data, respect the fat tails, and keep learning. We will see you next time.
That's it for today. I'll see you in the next episode. The Technical Intrinsic Value Podcast is a systematic explanatory to enhance data analysis and delivery. All content logics provided herein are a direct reflection of the opinions value modeled Nicolau Primavera Carvalho. The information provided is for educational and informational purpose only and does not constitute financial, investment, or legal advice. The TIV model is a framework designed to identify patterns based on 15 years of future results. All investments involve risk. By continuing, you acknowledge you are a self-reliant investor responsible for your own execution.